Welcome back to the deep dive. We've got a stack of sources here looking at Ethereum versus Solana. And our mission today really is to look beyond those sort of blockchain wars headlines.
Yeah,
I
exactly.
want to define the specialized roles these two, well, massive systems are carving out as we head into this more institutional Web3 era.
That's the key, I think.
Hmm.
This deep dive really shows they're not just competitors in the old sense. They represent fundamentally different ways of building these things, different philosophies. Ethereum, it's really cementing its place as that global decentralized settlement layer, the super secure place for high-value assets. It's going modular, prioritizing security, decentralization.
Okay, so the secure foundation and Solana.
Solana's taken the other path. It's all about raw speed, low cost, a monolithic design, high performance, aiming right at consumer apps, payments, anything needing that smooth, fast user experience.
So our sources seem to agree up front.
Yeah.
It's probably not winner take all. Specialization looks like the future.
Absolutely.
Yeah.
And to really get why, you have to start with that basic architecture choice, monolithic versus modular.
Okay, let's break that down, starting with Solana's monolithic way. So everything, consensus, data, execution, it all happens on that one main layer one chain, right? What's the big win for the user there?
It's simplicity, really. You get this single unified state for everything. No need for those complex, sometimes risky cross-chain bridges. Everything just works together, and it works fast.
How do they manage that technically?
Well, the big innovation is the C-level runtime. Think about Ethereum's EVM. It processes transactions one after another, like cars queuing for a single toll booth.
Okay, yeah.
C-level is different. It lets smart contracts run in parallel, using all those cores and modern processors. It's more like opening up a massive multi-lane highway. Things just flow much faster.
That's a good way to put it. Now, contrast that with Ethereum going modular. So the main L1 chain isn't trying to do everything anymore.
Exactly. The L1 is becoming super specialized. It's the ultimate settlement and data layer. The source of truth, incredibly secure. But the actual heavy lifting, the transaction processing, that gets outsourced to the layer 2's rollups.
Right, the L2s, so they handle the volume.
Yeah, think of the L1 like the super strong foundation of a skyscraper. It's maybe slow to build, but it's rock solid. The L2 rollups are like the express elevators inside. They bundle up thousands of transactions off-chain, process them quickly, and then post just a tiny compressed summary back to the L1.
And they inherit the L1's security that way.
Precisely. They get the speed and the security.
And we got two main types of these rollups, right? Optimistic and ZK.
Optimistic are, well, easier to build, compatible with existing Ethereum code. They just assume transactions are valid. But there's this typically 7-day challenge period where someone can prove fraud if it happened.
Okay, so a waiting period for final confirmation.
Right. ZK rollups, on the other hand, use some really advanced math, these validity proofs, to mathematically prove the transactions were correct instantly. So you get much faster finality, but they're definitely more complex under the hood.
So Ethereum gets top-tier security with this modular approach, but what's the catch? You mentioned friction earlier.
That's the trade-off, yeah. Fragmentation, your money, your apps, they get spread across lots of different L2s, and moving assets between them means using bridges.
Which adds delays.
Delays, costs, and importantly, potential security risks that you just don't have on a single chain like Solana. That friction, that's sort of the price you pay for Ethereum's Fort Knox level security.
Okay, let's shift to performance then. Speed, finality, the stuff users feel directly. This is where Solana really makes its case, right? Proof of stake plus proof of history. What exactly is POH doing?
So POH isn't actually consensus itself. It's more like a super fast cryptographic clock. It creates this verifiable timestamp, an order of events, before the validators even vote on the block.
Ah, so they already know the order.
Exactly. And because they have that agreed upon order, they don't need to chat back and forth nearly as much to reach consensus.
Yeah.
It just makes the whole process incredibly efficient.
And the numbers reflect that. Solana's block time is, what, around 400 milliseconds, super fast, and finality in like 2.5 seconds.
Just incredibly quick. Now, compare that to Ethereum's pure proof of stake using Gasper. Ethereum deliberately chose robustness over raw speed.
Okay.
Its block time is around 12 seconds. And finality, that point where a transaction is absolutely irreversible, takes a deliberate 13 to 15 minutes.
Wow, that's a huge difference.
It is, but think about it. If you're settling potentially billions or even trillions in value, maybe you want that 15-minute buffer to be absolutely mathematically certain nothing can go wrong. It's about security for high-value stuff.
Makes sense. So let's translate this to real-world scale. How many transactions can they actually handle? Solana is often cited as doing 800 to over 5,000 TPS in real use. Ethereum L1 is way down, like 1530 TPS.
Right, on the base layer. But the L2s collectively handle huge volume for Ethereum. The key difference is that throughput is sort of siloed within each L2.
But the killer app for Solana, from a user perspective, seems to be the cost.
Oh, absolutely. Yeah. Solana's fees are incredibly low and stable. We're talking fractions of a cent, like 0.000025 to 0.00025 per transaction. It's effectively free for most things.
And that just opens up completely new possibilities, right?
Totally. Microtransactions become feasible. You can do complex things in games constantly, or post to decentralized social media, pay tiny amounts for streaming content, things that just wouldn't make sense if each action cost even 10 cents, let alone dollars.
Yeah, whereas Ethereum L1 fees, the gas can still get really high and unpredictable.
Right.
L2 fees are much better, maybe $5 to $5.50, competitive with Solana in some cases.
True, but you always have that initial hurdle, that L1 fee you pay once to get your funds onto the L2 in the first place.
Yeah.
That bridging cost.
Right, that friction again. Okay, so these technical choices, they naturally lead to different ecosystems, different users, different money flows. Let's talk about who's actually using these chains. It seems like a split between capital depth and user velocity.
That's a great way to put it. Ethereum is undeniably the capital hub. Its total value locked, or TVL, in DeFi is huge, around $85.6 billion.
That's a massive number.
It really is. And it signifies trust, especially institutional trust. The transactions happening on Ethereum L1 might be fewer, but they often represent really significant economic value. Think big DeFi swaps, institutional transfers.
But hang on, if Solana is so fast and cheap, why isn't all the everyday activity there? What keeps that massive capital pool on Ethereum?
It comes back to security and trust, fundamentally. That $85 billion TVL is built on Ethereum's track record years of near-perfect uptime on the L1, plus that massive validator decentralization we'll get to. Institutions value that stability above almost everything else.
Okay, so Ethereum has the deep capital pools. Solana wins on the other side. User numbers.
Exactly. Solana leads in raw daily active users, often around 3.25 million addresses. Compare that to Ethereum L1's maybe 410,000, although L1 plus all L2s gets closer to 3 million, so it's converging there. But Solana processes way more transactions daily, over 35 million.
And what kind of activity is that?
It's the high-frequency stuff, enabled by low fees, trading, especially meme coins recently, depend networks connecting real-world hardware, blockchain gaming. It's the buzz of consumer activity.
Which explains why Solana's decentralized exchanges, like Jupiter, have seen such explosive volume lately, sometimes handling like 80% of all global DEX transaction volume.
Yeah, they've become the go-to execution layer for fast trading, even if the asset sometimes originated on Ethereum or elsewhere.
Okay, what about developers? Who's building where? Is there a difference?
Big difference, yeah. Ethereum has this huge advantage with the EVM, the Ethereum virtual machine. There's a massive global pool of developers who know Solidity, its main language, which is kind of like JavaScript. Yeah. Plus, the tools, the frameworks like Hardhat, OpenZeppelin, they're really mature. It's a powerful network effect.
The safe bet for many developers.
Kind of, yeah. Solana development mostly uses Rust. Rust is fantastic for performance and memory safety, but it definitely has a steeper learning curve.
So it attracts a different type of developer.
It tends to attract builders who are really focused on squeezing out performance, building those super fast consumer-style apps that just wouldn't work well with higher fees or slower speeds. The language choice itself signals the network's focus.
Interesting. Okay, let's pivot to something critical for institutions. Security, risk, reliability. How do they stack up on decentralization?
It's quite stark. Ethereum boasts over 1 million validators. That's huge decentralization, huge resilience. The main centralizing pressure isn't hardware. It's the capital needed. You need 32 ETH to run a validator, which is a lot of money.
Okay, so capital is the barrier. What about Solana?
Solana's bottleneck is hardware. Running a Solana validator requires serious gear server-grade stuff, 24-core CPUs, tons of RAM. The setup cost can be anywhere from $5,000 to over $15,000.
Wow. So that limits who can participate.
Significantly. It means the validator set is much smaller, around 1,500 to 2,000. And they tend to be professional outfits running in data centers. So the centralization risk on Solana is more about concentrating hardware power among fewer players.
And that focus on performance, has it historically impacted reliability? That's a big concern for institutions.
It has, yeah. Ethereum L1 has an almost spotless uptime record going back to 2015. Solana, while it's improved massively, has had several well-publicized outages and periods of degraded performance in the past.
Usually triggered by what?
Often network spam, sometimes bugs in the validator software. It's definitely something they're working hard on. But that history remains a concern. for users who need absolute guaranteed uptime.
We should probably clarify that failed transaction number people see for Solana, often like 75% or higher. That sounds terrible.
Right, it does sound bad, but it's misleading. Our sources are clear. The vast majority of those aren't your transaction failing. They're intentional programmatic failures from arbitrage bots.
Bots just spamming the network.
Exactly. Because fees are so low, bots constantly fire off transactions trying to capture tiny price differences. Most of those attempts fail by design or get blocked as spam. It creates network noise and congestion, yes, but it's not typically users' transfers or swaps failing. It's a consequence of the low-fee design attracting bots.
Okay, that's a crucial distinction. So maybe Solana's past instability is largely bot noise, but how does the institutional market, which obsesses over stability, view that? Which brings us to this market shift.
Yeah, the whole crypto market has matured. 2017 was that wild ICO boom, retail FOMO, pure speculation.
A bubble, basically.
Pretty much.
Yeah.
The 2025 market, as our sources frame it, is different. It's about serious institutional capital entering the space. Their decisions are driven by regulation, real-world use cases, and yes, that hardcore security and reliability.
And we're seeing crypto markets move much more closely with traditional finance now, right? Like reacting to Fed news or macro fears.
Absolutely. The correlation is much tighter. The digital asset world is plugged into the broader economy now.
And arguably the biggest driver of that connection has been the ETFs.
Without a doubt. The spot Bitcoin and then Ethereum ETFs, they created that safe, regulated bridge for traditional finance to easily get exposure. The money flowing into and out of those ETFs is now a major price driver.
And naturally, everyone's watching to see if or when a spot Solana ETF might get approved, maybe late 2025.
That's the speculation,
Yeah.
yeah. It would be another huge validation if it happened.
Okay, let's tie this all together. Strategic outlook. It really does seem like complementary roles is the most logical conclusion from the sources. Ethereum is positioning itself as what? The digital bond market?
Yeah, or like a central bank settlement system.
Yeah.
The bedrock layer.
Its main jobs being institutional DeFi, settling huge value transfers, and crucially, being the foundation for tokenizing real-world assets, RWAs, things where trust and security are paramount.
Exactly. And Solana. It's carving out its niche as the high-speed transaction layer, like a global payment network, think Visa, or maybe a consumer app platform like the Apple App Store.
Built for scale and user experience.
Right, things like consumer payments with Solana Pay, decentralized social media, gaming, high-frequency trading on DEXs with those on-chain order books, VPN. Anything needing that sub-cent cost and instant feel.
What are the big catalysts to watch for each?
For Solana, the big one is the full rollout of FireDancer. That's a completely new validator client built by Jump Crypto. It promises major improvements in resilience through client diversity, meaning if one type of software has a bug, the others keep running and potentially pushing speeds even higher, maybe past 1 million TPS eventually.
Wow, okay. And for Ethereum?
Continued improvements on the L2s, making them even cheaper and better. We already saw EIP 48842 dank shorting slash the cost for L2s to post data back to the L1 by over 90%. More upgrades like that will keep reducing user friction.
So pulling it all together for you listening, how should you think about this? Maybe view Ethereum as that core sort of blue chip holding in a portfolio, the conservative secure settlement layer.
That seems reasonable, yeah. And view Solana as maybe a higher growth but also higher risk part of your allocation. Exposure to that fast-moving consumer and application layer.
And for developers, it seems pretty clear too. Need maximum security, decentralization, access to deep capital, build on Ethereum or its L2s. Need that seamless UX, real-time speed, ultra-low costs. Solana looks like the place.
It really boils down to matching the tool to the job.
So the big takeaway here isn't about picking a winner. It's understanding how they specialize, how they actually need each other for Web3 to really scale to billions of users and trillions in value.
Exactly. Well, one provides the ultimate security anchor. The other provides the scalable execution for everyday use.
Which leaves us with a final thought for you to chew on. We hear a lot about real-world asset tokenization being this multi-trillion-dollar opportunity. So once those assets, stocks, bonds, real estate are tokenized, where's the real long-term advantage? Is it with the chain that offers the absolute highest security for holding those assets like Ethereum?
Or is it with the chain that can handle the highest velocity of trading and interacting with those assets once they're live, like Solana? Where will the value accrue? Something to think about.
Definitely something to consider. That's all the time we have for this deep dive.